Welcome back. It is time for the Word on Wall Street. Top investors watching your money. Joining me right now is Claro Advisors Managing Principal and Founder Ryan Belanger and Michael Lee Strategy Founder Michael Lee. Ryan, as usual, we've got a big week of economic data, Mike, and that's going to impact these markets. September retail sales are coming out tomorrow morning. We've got the October NAHB housing index followed by the September housing starts and building permits on Wednesday. Existing home sales coming out on Friday, Mike. And look at this yield on the 10-year. Last week, the end of the last week, we saw the 10-year Treasury at around 4.6%. That's down from where it was just a couple of weeks ago. This morning, we've got yields higher. What's your take on the 10-year Treasury up 8 basis points right now, Mike? It's sitting at 4.706%. That's not a good number for stocks.
No, Maria. So in line with the war in Israel starting, you had hedge funds and CTA, commodity trading advisors, all very, very short heading into that. And so the flight to safety that we saw in the buying of the 10-year and all the way out the maturity curved out to the 30-year, that sparked a reversal in all of that selling because it's this dollar strength through fixed income selling off. So when the dollar gets abnormally strong on a very quick time frame, that's bad for all risk assets in the U.S. And so now the Treasury is retracing some of the gains that it made over the last week that we saw in that flight to safety. I don't know how much left and how much higher yields we're going to see because, as Ryan just mentioned, the consumer is weakening substantially. You have 92% of households, according to a survey from Morning Consult that came out last week, plan to cut back on discretionary spending over the next year. You're starting to see it in credit card data. So outside of the top 100 banks, credit card defaults have hit an all-time high. Okay, on top of that, you saw it from JP Morgan's card spend data. It was up 8% year over year, but the savings rate, the savings deposit balance at JP Morgan were down that same 8%, and charge-offs had almost doubled from them. So we're starting to really see the cracks around the edges. And I'd be very careful to read too much into tomorrow's retail sales number because the Bureau of Economic Analysts and a lot of these other institutions out of Washington, D.C. have been extraordinarily creative in the use of seasonal adjustments to make the data look far better than it actually is on the inside of it. And when you look at the New York Fed survey of financial conditions among consumers in the U.S., those that are much worse off than a year ago are hitting levels, if you take out COVID, not previously seen. So we're about to see consumer spending fall off a cliff, and then we're going to see housing data grind to an almost halt because interest rates are so high, which stops people from buying new homes, stops people from selling their homes. It also stops builders from financing the building of new homes. Okay, there's a huge multiplier effect to that's occurring in our economy, that less people building homes, working on homes, it slows the entire economy. So, look, I do not see good things in front of us.
Well, we're going to get that then from the guidance when we get these earnings. I mean, we're going to have to hear from management teams about what they're expecting fourth quarter of next year. So all of what you're saying may very well be transparent in the coming weeks. We'll be watching, of course. Ryan, thank you so much for being here. Mike, always a pleasure to see you. Ryan Belanger and Mike Lee, thanks for the Word on Wall Street, guys, and we'll be right back.